Passive Pockets is presented by Equity Trust. If you're in the investment or syndication world, you know the drill. Your inbox is overflowing with deal after deal after deal, each one promising big returns and claiming to be the one. But with so many to sort through, how do you know which are worth your time, which to skip, and what really matters in that first pitch? That's where we come in. Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. I'm your host, Jim Pfeiffer, and with me is Paul Shannon. Today, we're testing out something new. We're breaking down real investment pitches straight from our inboxes. No hypotheticals, just actual deals, dissected in real time so you can learn exactly what seasoned investors look for at first glance. Then, once we've gone through all the info in the email, we'll make a choice. Dig in or delete. Now, remember, we're not making investment recommendations. This is strictly for educational purposes only, but we do want your feedback. Let us know what you think of this new format. Should we do more episodes like this? Should we do fewer? Different types of deals? Anything you want to share about this new format would be appreciated. You can share your thoughts in the Passive Pockets forum, or you can email me directly at jimpfeiffer@biggerpockets.com. And with that, let's get into it.
All right. Thanks, Jim. And I'm excited to get going here. Boy, do I have a deal for you to get going here. This is exciting stuff. So all these emails that I've collected over the last few weeks, I've just stashed into a folder in my inbox. I haven't opened them up. I haven't looked at them. So I'm kind of reacting to them for the first time as well. So here's one. The first one I'm going to read to you. It's an apartment deal in Tampa, Florida. It's 2015 vintage, being acquired at what is described as an exceptional basis, 20% below sales comps. Looks like it's got some upside of 15%. I'm not sure what that indicates, but assumable debt, 4.59% fixed rate.
I like the assumable debt. So far, Tampa, it's a good market, I think. Florida, I'm okay with Florida. Especially in the middle of Florida there, and the assumable debt sounds good. I don't know how they get to the 15% upside. That seems a little low, depending on the hold time. But what do you think of it so far?
I'm interested. I'm going to keep reading on here. So here's some more tidbits.
We have not deleted it yet.
Not yet. No, that's the first paragraph. So we've made it past that part. That's good.
That's something.
All right. Going in cap rate of 5.71, day one cash flow, 40% of the total return coming from cash flow. We talk about IRR partitioning quite a bit. That's how much of the projected returns are coming in the form of cash flow distributions versus profits from the sale and exit. That's pretty attractive. That sounds conservative. As
a cash flow investor, I love immediate cash flow. And I like the fact that 40% of the overall hold time returns are coming from cash. So I'm still reading. I haven't clicked delete yet.
All right. So the property is going to benefit from the experience of the sponsor. In their opinion, it's a 4-year hold. Back to that assumable debt, it's a 57% loan to cost. I'm assuming if it's loan to cost, they're probably bringing some CapEx here.
So we'd have to ask that. But my first question, my first kind of seeds of doubt, because let's be honest, as I'm looking through these, I'm looking for reasons to say no, right? Because these are basically cold pitches from operators maybe I don't know, but you can't just eliminate anybody you don't know. I still want to look. This is what I do for a living, so I'm curious. But a 4-year hold time, I haven't seen that very often before. In the olden days, when all the returns were great, people were doing 5-year pro formas and turning around in 3. Now you see pitches for 5 years and you can expect it maybe to go 6, 7, 8 years. So I'm curious why they say 4. And that would make me ask questions like, is the debt, it's assumable debt, does that only last for 4 more years? So those are some questions in my mind. So now I have a couple seeds of doubt.
That would be my guess, is that there's 4 years remaining on the term, 4.9% fixed rate. Tough to say when that loan would have been originated. So good question there. Definitely want to dig into that. So the projected returns it looks like there's 2 share classes. One's named standard and one's named major. I'll just read the standard one. That's probably the lower check, which the minimum is 100,000. 17.6 AAR, 15.5 IRR. These are all projections, of course. 7.1% average cash flow. It says it begins at 6.5. An equity multiple of 1.7 over the 4-year hold. So what are your thoughts?
It's hard to look at those numbers and really understand them. When you have an IRR of 15 on a 4-year hold, I guess that's where you get the equity multiple of below 2. I would expect an equity multiple above 2 on a 15% IRR. But the IRR takes into account when those cash flows come in. So maybe that's in line. I usually look for a double, right? Double your money in 5 years, and maybe it's double your money now in 7 years instead of 5. So still have some questions, but I haven't, have not hit delete yet.
Tough crowd. Wow. I mean, come on, Jim. Wire that money. Let's go. Well,
Yeah.
I'm actually a little bit interested. I think it's obviously the market has done well in the last couple of years. It's been tough there, but having spent some time researching Tampa, I'm invested in one deal down there. The going in cap rate of 5.71 is pretty attractive considering that stuff was trading in the 3 cap range, or a little bit higher than that.
Well, let me ask you this, Paul. How do you confirm that cap rate is correct? I mean, I could say it's a 10 cap rate, right? And I don't know.
Sure. Well, we can't do that from this email, of course. This is just a kind of initial gauge of interest. And should we dig in further? So I would want to look at the offering docs, the underwriting, and find out what are the inputs? Does the business plan match the debt? Is it realistic to push rents by, it looks like 15% is what they're baking in here to get to the returns. I've always been a big person when it comes to evaluating the outputs, which are the fancy metrics like IRR, equity multiple, and cash flow. I want to understand the inputs that are used to arrive at those outputs. So I would want to dig into that if I were going to take it to the next level. But I would first of all talk to the operator, get on a phone call with them, and just kind of hear their pitch for the deal and what gets them excited and kind of the story behind the project. But I think this is one worth looking into.
Does it say 15% over the hold period? So that's 15% over 4 years. Does it break it down by year by year?
Not in the email, no. It just says exceptional basis that's 20% below sales comps and has value add rental upside of 15%. I would assume that that's bringing rents to market as to where they are today, but that maybe isn't true. So we could find that out with additional research. But first pass, kind of interesting. You want to do another one?
Yeah, I guess just to close the loop on this one, I guess it's one that I didn't delete, and I would put into my maybe look into some more pile, depending on who the operator is and all of that. And where did it land in your pile? Is it delete or still investigate?
I would investigate this one, actually. I think it's interesting enough, given what I know about Tampa and, the metrics. And, I think that the group has a decent track record. I don't have experience investing with them. I have talked to them in the past. So this is one where, I might look into it and make a phone call.
It's not delete. It's dig in on this one.
Dig in.
All right. I'm surprised, Paul. You're digging in. Let's go to the next one.
Here we have a shopping center. It's a grocery anchored neighborhood retail center in Northeast Philadelphia, 98% occupied. There are 2 pad sites that can be developed for additional income. It sounds like they've already negotiated for a company that's a fairly well-known retail outfit.
Do they say what that is?
Discount Tire.
Everyone always needs tires.
And then the second pad site, they also have a LOI with 7 Brew Coffee. So that's a pretty up and coming, competitor of Starbucks, 15-year lease, 10% escalations every 5 years. That's pretty good. 2 deals. We're projecting to return 55% of your initial investment by the end of year 2 on our 7-year hold.
How do they do that?
Doesn't say. So that's all the information we've got. It's kind of a, hey, this is, what's supposed to get you excited and grab your attention, and then they want you to click on their portal to get to the next step.
I got to tell you, I expected to be delete on all of these, and that one so far, I like neighborhood retail. Northeast Philly, I don't have anything in Philadelphia, so that's maybe a diversification play. I assume that's up in the suburbs of Philly somewhere. I would be curious. Obviously, we're going to get more information, but I'd be curious about what the anchor tenants are currently in that, because I've had some success on neighborhood retail, so I do like that asset class, and I think obviously you need a lot more information. But definitely interested. So I guess it's dig in for me.
Yeah, I think I would too. There's not enough here really to go off of. I think, honestly, when it comes to this kind of stuff, if your inbox is getting slammed and this is all the information you have to go on, you're like, yeah, I'm interested, but then you may forget about it because you got other stuff that's a priority. You got work, you got pressing issues in your life, and then this gets kind of pushed to the back burner. So I'm sure I'll get a reminder email about this opportunity as they continue to raise capital for it, and maybe I'll have the time. But this is one where I feel like it hasn't completely hooked me. I like what I hear or see or read from the initial, first pass, but it could be one of those where I just don't get around to it, frankly.
The interesting thing there to me is neighborhood retail. So it's an asset class I like. So already I'm interested. And then you say it's 98% occupied. So assuming they have those rents, so it should be cash flowing and good to go right out of the gate. And then you have value add that's already, you have LOIs, letter of intents, right? For 2 retailers that are, at least one of them is probably recession resistant. You need tires, you need tires. Coffee, people are always going to drink their coffee. So I think it's intriguing. So I might be if we have a dig in plus, that's kind of where I am because I like the asset class.
I'm a dig in minus. I'm kind of a little worried about a recession right now. So I would definitely want to know who are the retailers. The fact that it's grocery anchored is, I suppose, a positive, but sometimes that can be a negative because if the grocer moves out, then the rest of the tenants are really going to suffer. So I'd want to find out, who are the other tenants in there? Are they recession resistant? Are they Amazon e-commerce resistant? Is there any value to add in the property? Are there vacancies where potentially not just the outlots, but in the strip center where you can maybe update some signage, the parking lot, get some new tenants at a higher lease rate? Is it triple net? Is it double net? Is it gross rent? I don't know. So a lot of questions to ask here, but definitely interesting. It hasn't turned me off. So I like it.
All right, Paul, I'm going to throw one at you. This is a 126 unit multifamily offering with a minimum investment of 50 grand. And again, I'm just looking at the email. It's a core plus multifamily property. And that doesn't really help me because people have different definitions of core plus, but they call it a core plus. And they are partnering with someone they've partnered before. And it's a value add strategy. It has a lower risk profile compared to their usual value add, but still delivering the high returns we've come to expect. That's it. Well, to be fair, it's part of their newsletter, and it's just announcing that they have this investment, and then there's links where you can click on stuff. So would you be enticed to click further, or are you just like, that's not enough to tease me in?
Do they mention who the partner is and where's the asset located?
It's in Gainesville, Georgia, which is outside of Atlanta. But other than that, they do not say who the partner is, and there's nothing else except a long newsletter about core and core plus and how they define things, but it's not specific to this asset.
Are there any return projections on there?
No. There's a picture of a pool.
I'm sure it's a nice asset. It might be a good opportunity, but it's almost like, I hate to say it because marketing, we've seen that there are good marketers out there who are bad operators, but in this case, their marketing isn't enough to catch my eye. Like there's too many things going on in life where that's not going to be the one that I'm like, okay, I really need to focus on this one because this is a great opportunity. It's just like, okay, I know that these guys are relevant. They're doing deals, but I don't know anything about this deal. And I have to do too much work to get the information that I need to, make the decision as to whether or not I'm going to, dig in. So I sort of have to dig in if I want to find out more, but I don't have the time to dig in and I'm not interested enough to do that. So if that makes sense.
I agree. And to be fair to this operator, it is part of a newsletter. So it's kind of like, hey, we have a new deal and we're just including it in our newsletter. So I agree. I don't want to have to click on all these links to get the information. Now I know the operator, so that changes it. If it was somebody that I wanted to invest again with, maybe I would go and dig in. Or if it's somebody that I have enough with them right now, then I would just delete. And that doesn't say anything really about the deal, right? So I think in this one it's a delete just because there's not enough information to make me jump into it.
I've got a sexy one here I want you to hear about.
Oh, yes. Okay.
Let's see if you get excited about this one. So this is a fund that is acquiring marinas. So not just the business, but the real estate as well. Fund size is 15 million. Targeted returns are 30 IRR with an 8 to 10% preferred return. I'm sure that's based on tiers that are not listed here. 50K minimum. Their strategies to acquire and reposition underperforming marinas with high occupancy, multiple revenue streams, and limited competition. Distributions are paid quarterly.
I'm already a delete.
Really?
And there's only one reason probably why I would delete. I would open it because marinas. I'm interested in marinas. I think that's a great, it's like the new RV park. It's just a new asset class. And I think what's going to happen, a lot of these lakes that people have, there's marinas on all these lakes, and probably someone's going to go in and roll up a bunch of these and make it into like, a big marina fund, and then they go sell it to private equity or something. That sounds fantastic. But the reason why I'm probably a delete already is because when you say 30% IRR, I just don't believe you. That's it. It might be true, but it just seems 30% IRR. And what did you say the cash on cash was like 8 or 10?
Doesn't say. It just says 8 to 10 pref. It doesn't say whether that's current or accrued.
Okay, it just seems outlandish. So, and this might just be my bias. Like if you tell me you're getting a 30% IRR in this market, I'm probably not going to put 50 grand into that unless I know this operator very well and I know that their expertise is marinas. If I was in an investing group of 10 people or 20 people and we could get into a deal like this for $2,500 or $5,000, then it would be a dig in because then I'd take a flyer just to test it out. But I'm not taking a flyer to test something out on a new asset class that's promising really good returns. That's probably just a no for me. Is there any other information that can maybe make me change my mind?
A little bit. So it says, what makes this unique? Multi-income model from boat slips to RV parks, retail, gas docks, and more. High barriers to entry, strong regulatory protections, limit new development, and attractive exit strategies. 6 to 8% projected exit cap rate or year 4 refinance. And then they give you access to a webinar and their deal room. And that's it.
I don't know. Maybe I deleted too soon, but they do make a good point. You're not building a marina next door, so that's a plus. But also with these recession fears that are swirling around now, boating and buying expensive boat gas and ice cream cones and all that other stuff you have at the marinas, I don't know. That could certainly switch off pretty quickly. So I think I'm probably going to stick with my delete, although it hurts me a little bit because I love chasing the shiny object. And there's 2 shiny objects on this one I like. One is a 30% IRR, which I like, but it also scares me. And the other one is just a new asset class. I love that idea. So probably delete, but probably put the sender of this email in my address book so that the next one that comes along, I can look at that one too, because I'm interested, but probably not moving forward.
Fair points. Yeah. I think if you're looking at the risk spectrum, this is probably pretty far out on it, right? We don't know the operator. We don't know their experience. And assuming that they are solid operators of marinas, that certainly, makes it a little bit more palatable from a risk standpoint. But still, there's definitely risks involved, I would say. I guess what I do know about marinas, and having a slip for the last 3 years myself, I've seen my rent go up by about 5 or 6% a year. And there's really nothing I can say or do about it. There's like a 10-year wait list. I got lucky to get in on one that became available in 23. And it's basically a monopoly. There's no other options in town. There's nowhere to go. So, and there's also not been a lot of consolidation in the space where there has been in, asset classes like self-storage, mobile home parks. I think I heard the other day that self-storage has been consolidated like 50% to large owners of that own a number of different assets or private equity or syndicators or whatever, where 50% are owned by mom and pop. There's still an opportunity for consolidation in that space. Marinas, I think, is like, sub double digits as far as the consolidation. So it's kind of ripe for private equity, potentially for roll-ups. So I think that would be kind of the excitement behind it. But you're really taking a chance here, I think. So would I look at further into this? Absolutely. I'd want to have a conversation. It's piqued my curiosity. Would I invest in it? There's a lot to know more about before to make that kind of decision. But even if I did invest in it, it would be like, whoa, this is a bigger risk. Let's put a small chunk in here and let's assume that I can lose it all.
Yeah. And that's where, putting together a tribe vest tribe or something like that makes sense for these kind of test them out asset classes or operators. All right. I got one for you. You're going to love it. You ready?
Okay.
It's an exclusive opportunity to invest in a 54-lot mobile home park with 81% occupancy and strong value add potential. There's a map, and in it is a big square, and about a third of the map is filled with mobile home parks, and the rest is forest. So I'm assuming that's the value add. They can add more lots. Minimum is $25,000. I like that. 2 share classes. So we'll look at just class B because that's the lower share class. So I assume that's the 25,000 minimum. 22 to 24% IRR, 2.93 equity multiple. You can soft commit today. Click on these links to get more information. And the best part is the deal will go fast. Soft commit now. If you express interest and you don't make it in this one because they're oversubscribed, you'll get priority access to the next opportunity, which is 150 site property, but it's in a parentheses within a parentheses within a parentheses, so it's a little bit confusing.
So they're kind of creating some urgency here is what they're trying to do on that message.
Yes, the FOMO says invest now.
And we all know that this space is full of generational opportunities that we have to seize right away. So I better commit soon. But no, I would not, because first off, what caught my attention was like 50 something pads. That's a pretty small park. I think that there's limited buyers for that size park. It's probably more difficult to manage from a system standpoint and operational standpoint. So I would be worried mostly about exit. So that would be one thing, is like, when am I going to be able to get my money out? And then 2 would be, you described the area and you mentioned that there's a bunch of trees around it. That concerns me with mobile home parks. I'm assuming this was built a while ago because it's tough to get permits for new parks. Most of those parks were built when clay pipes were the building construction material that was used in plumbing that run underground. And if you got a lot of trees around clay pipes, that's not really a good thing. So I'm guessing that there's probably some plumbing issues. And if you have to dig up and repipe an entire park, that's a major CapEx risk. So for those reasons, I would just say probably not.
Again, this might be stupid, but I get nervous about the 20 plus IRR and the almost 3 equity multiple. And honestly, what really would make me delete this one is just the fact that they are, the deal will go fast, soft commit now, all that pressure. And I understand that you have to be an operator and you have to be a salesperson, but I kind of like it when they're just like, hey, here's my deal. It's good enough for you to just dig in because it's good enough. I don't have to convince you. I don't want to be convinced. But I get it. It's sales. So this could be a fantastic deal. I don't know, but I think it's a pretty easy delete for me.
Okay. You want to do another one?
Yeah, let's do one more.
This one I've got, it looks like a rendering in the picture. It's going to be a luxury storage development. It's in Iowa near a popular lake in the region. Breaking ground in April of 2025 as we're recording this. It could be getting underway. It's a $6.8 million total project. That's the development cost with a target 2x.
What's luxury storage? Sorry, I should have asked that before you got rolling.
It looks like a new storage facility that has high ceilings. So potentially, because it's near a lake, it's got maybe the ability to store boats or RVs, and maybe it's climate controlled. I don't know the definition, but that's what it looks like. So 2x equity multiple, quarterly distributions, $100K minimum investment. It says we've spent years refining our luxury storage model, and we're scaling it into key markets where demand far outstrips supply. Got a live webinar here coming up to register. That's what I got for you. What do you think?
I don't understand why you're telling us there's quarterly distributions on a development deal that you don't put any other information on, right? So this might be a great deal. This might be a bad deal.
Sorry, Jim. I don't want to have you dig into that too much because it does say estimated by Q4 of 2026 once it's stabilized. So
I guess still it's not enough information really for me to get super excited. This sounds like a deal that is sent to someone who already knows the operator, knows what luxury storage is, and might be interested just on that. I'm not a huge development guy just because I'm a cash flow investor. Every once in a while, I want to do a development deal here or there. Pluses is Iowa. I don't have anything in Iowa. And whenever I hear a market that I haven't seen anything before, that piques my interest because it's diversification, right? Then I don't have to be all Phoenix and Tampa. I got something else. But I would probably delete this one just because it just doesn't intrigue me and I don't understand it.
I'd probably do the same. I'm not really a development guy myself either. I don't know really the definition of luxury storage. I'm sure the sponsor has done, their work in part and tried to educate around that to their investor base, but I haven't spent the time to learn it myself. And, it's kind of a niche space. And as you get farther out away from kind of core asset classes and you get into these little niches, the risk obviously goes up. So, I think there is some uniqueness. I've heard a lot of I like flex industrial personally, but more for the business owner or the franchisee that has a need for office space, small office for their team to meet in the morning and then a place to store their overhead. Not necessarily these luxury spots where they can store their toys because, again, when a recession comes, if it comes, these are kind of the first things that get cut out. So that to me would be my concern. So I would probably delete this one.
Excellent. Well, just to summarize a little bit, the goal of this was to figure out how do you go through your inbox and figure out what you're going to delete and what you're going to dig in for. Now, we completely ignored sponsor. So obviously, if you know the sponsor, you're more likely to dig in. And if you don't know the sponsor, you're more likely to delete. But the goal, again, was just to kind of see how people go through their inboxes, right? We'll hope in the future, if people like this type of episode, we'll get other LPs on here and see how they do it. Maybe they do it differently than Paul does it, or maybe they do it differently than I do. That's a wrap for today's inbox inspection. We hope breaking down these real deals helped you sharpen your own filter for what's worth a reply. And remember, let us know what you think of this format. Should we do more of these episodes? You can share your thoughts on the forum on PassivePockets.com, or you can email me directly at jimpfeiffer@BiggerPockets.com. We'd love to hear what kind of deals you're seeing in your inbox. You can start your 7-day free trial to PassivePockets.com today. Thanks for tuning in, and as always, happy investing.